My name is Christian Wilber, and I cover domestic financials for the Marquette AIM Fund. Helped by my mentee Anwar Ahmed, I will be presenting Lending Club. Lending Club is the leading digital marketplace lender in the United States, with a current revenue breakdown of 2021 of 66% origination and servicing fees, 31% interest income, and 3% off the gain on sale of loans. The firm uses AI and machine learning to underwrite unsecured loans for credit card, auto, and debt consolidation, as well as other personal uses. The integration of Radius Bank gives them top rates for high yield savings accounts, checking account cashback, and a full suite of fintech offerings. The firm is founded in 2006 and headquartered in San Francisco. It currently serves 3.8 billion members. Following a 2016 restructure of the executive board, the firm's strategy was focused on increasing shareholder value by diversifying the consumer loan portfolio, marketing to drive new customer acquisition, and investing in infrastructure to increase automation and the delivery of new products. Management continues to deliver on this three-prong approach, and they exited the peer-to-peer industry in 2020 while acquiring a banking charter that comes with several efficiencies, including lowering overhead costs. This allowed them to grow from 3 to 3.8 million members in the first 9 months of 2021. Lending Club is currently trading at 40% below its recent price following an earnings beat, mostly because of overinflated macroeconomic fears, such as the Omicron variant and rate tapering. However, the fundamentals are stronger than ever. It is recommended that Lending Club be added to the AIM Small Cap Fund with a price target of $42.56. In February of 2021, Lending Club acquired the award-winning Radius Bank for $185 million. This adds $2.4 billion in assets and an award-winning fintech suite. More importantly, it provides Lending Club low cost deposit funding to be able to hold loans on the balance sheet and regulatory synergies as they no longer have to pay duplicative costs. It allows them to retain prime loans on the balance sheet, which have a 12% margin versus 4% in the area they previously operated. They currently hold roughly 20% of the loans and sell 80 on the open market. They only retain prime loans with a 715 FICO score or above, allowing less liquidity risk. This also allows them to adjust the optimal holding ratio, which makes it more flexible in macroeconomic changes than it was previously, and other competitors in the space. After 15 years of originating personal loans and over $68 billion lent, Lending Club now has a proprietary underwriting model that aggregates over 150 billion rows of data and is incredibly accurate. The average credit card consolidation now saves up to 400 basis points for a lender. Because of this, 80% of loans are now originated automatically, while competitors like Upstart can only reach a 67% level. It reduces overhead and increases profit margins while allowing applications to take minutes to process. Lending Club also is able to boast industry low fraud loss below 5 basis points and a delinquency rate that is 35% below the industry. Lending Club is also expanding into new profitable verticals that allow them to diversify the loan portfolio. In 2021, they introduced an auto loan consolidation product that allows borrowers to save an average of 500 basis points and $4,000 over the life of their loan. Auto loan originations grew 85% quarter over quarter in Q3 and now cover 94% of the country. This expands their total addressable market to $1.3 trillion dollars and diversifies the portfolio further. Furthermore, Lending Club is introducing a buy now, pay later product in 2022 that's going to cover educational expenses, dental, and elective medical procedures. To find a proper valuation of Lending Club, first, a discounted cash flow was created using a weighted average cost of capital of 7.83% and a terminal growth rate of 1.5%. This reached an intrinsic value per share of $39.23. Additionally, a sensitivity analysis on the DCF was created for the weighted average cost of capital and terminal rate with a plus or minus 100 basis point spread. This gave a range of $35.34 to $46.01. A price to sales multiple was created using a peer average of 10.22 times and resulted in a price target of $72.86. Finally, a price to book multiple was created using a peer average of 4.81 times, resulting in a target of $38.83. Weighing these models, 80, 10, and 10, a price target of $42.56 was achieved, giving an upside of 37.86%. Several risks were identified along with the lending club thesis, including interest rates. While interest rates increase the profitability of lending as the loan spread increases, it also reduces consumer willingness to borrow in the future. However, the portfolio is slightly less sensitive to interest rates overall as it has a shorter duration. There's a credit risk, as loans held on the balance sheet expose lending club to the credit risk of the borrower and therefore could pose liquidity issues if they needed to recapture those funds. There's also a funding risk. Low availability of institutional funding could require lending club to retain more loans than desired and potentially restrict cash. The management team is comprised of Scott Sanborn, who has been CEO since 2016 and was previously CFO and president of Lending Club, as well as Chief Revenue Officer of eHealth. Tom Casey is the current CFO and board member and has held the position since 2016. He has 30 years of industry experience and was previously the CFO at JPM, Citibank, and Washington Mutual. And finally, John C. Morris was chairman of the board, who's held this position since 2013, and was previously president of Visa and Citibank, where he spent 27 years.